What's happening right now in the precious metals market should terrify anyone who's been paying attention to the banking system. And I'm not talking about some distant theoretical crisis. I'm talking about something that's unfolding in real time, something that the mainstream financial media is either ignoring or deliberately downplaying. Because when you look at what central banks are doing, when you see the panic buying of physical gold, when you understand the mechanics of what's actually happening behind the scenes in the global monetary system, you realize we're watching the early stages of a financial earthquake that's going to reshape everything we thought we knew about money and wealth preservation. Let me start with something that should make your blood run cold. Central banks around the world just purchased over 160 tons of gold in a single quarter. That's a 41% increase over typical quarterly levels. Now you might be thinking, okay, central banks buy gold, that's normal. But here's what's not normal. These aren't just routine purchases. These are panic purchases. These are the actions of institutions that know something the general public doesn't. And when you dig into who's buying and why they're buying, the picture becomes crystal clear. The people who run the global financial system are preparing for something catastrophic. Think about this for a second. Central banks are the ultimate insiders. They have access to data and intelligence that you and I will never see. They understand the fragility of the banking system better than anyone because they're the ones propping it up. And right now, they're converting their paper assets into physical gold at a pace we haven't seen in modern history. The BRICS nations, Russia, China, India, they're not just buying gold as a hedge. They're building an entirely new monetary system designed to function outside of the dollar-dominated framework that's controlled global finance for the past 80 years. Before I go any further, I want to make sure you have access to something that could be crucial for your financial future. I've put together a comprehensive free guide that shows the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth from what's coming. It's in the description below. This isn't some generic financial advice. This is specific, actionable information about how people are positioning themselves for the monetary shift that's already underway. Grab that guide, because what I'm about to show you is going to make it very clear why this matters. Now let's talk about what's really happening in the banking system. The mainstream narrative is that everything is stable, that the regional bank crisis we saw was contained, that the system is resilient. But that's not what the data shows. That's not what the behavior of sophisticated institutions reveals. When you look beneath the surface, you see a banking system that's fundamentally broken, held together by central bank intervention and accounting gimmicks that would make Enron blush. Here's the reality. Banks are sitting on massive unrealized losses in their bond portfolios. When interest rates went up, the value of those bonds went down. Basic math. But because of how accounting rules work, as long as banks don't sell those bonds, they don't have to recognize those losses on their balance sheets. It's called held-to-maturity accounting, and it's allowing banks to pretend they're solvent, when in reality, many of them are technically insolvent. They're zombies, kept alive by the Federal Reserve's willingness to accept those underwater bonds as collateral at face value through various lending facilities. What happens when depositors start to lose confidence? What happens when people realize that their bank is only solvent on paper, that if there's a run, if people actually want their money back, the whole thing collapses? We got a preview of that scenario. We saw how fast a bank can go from seemingly stable to completely insolvent. And the solution wasn't to fix the underlying problem. The solution was to guarantee deposits, to create new lending facilities, to essentially promise that the government and the Federal Reserve will backstop the entire system no matter what. But here's the question nobody in the mainstream media wants to ask. What happens when the backstop itself becomes questionable? What happens when people start to doubt not just individual banks, but the currency itself? Because that's where we're headed. That's what the central bank gold buying is telling us. These institutions understand that we're approaching a point where confidence in fiat currency, confidence in the dollar, confidence in the entire debt-based monetary system is going to crack. Let me paint you a picture of what this looks like in practice. Imagine you're a central banker in a country that's been accumulating dollar reserves for decades. You've been playing by the rules of the international monetary system. You hold US Treasury bonds, you conduct trade in dollars, you're part of the club. But then you watch as the United States weaponizes the dollar. You see sanctions, you see asset freezes, you see the dollar being used as a tool of geopolitical control. And you realize that your reserves, your wealth, your economic sovereignty, it's all at the mercy of decisions made in Washington. What do? You start diversifying. You start buying gold, not because you think gold is going to give you a return, but because gold is the only asset that's not simultaneously someone else's liability. It's the only form of money that can't be printed, that can't be sanctioned, that can't be frozen with the stroke of a pen. And that's exactly what we're seeing. Countries that have been part of the dollar system for generations are quietly, systematically moving away from dollar dependence and into hard assets. The BRICS nations aren't just talking about creating an alternative currency, they're building the infrastructure for it. They're establishing bilateral trade agreements that bypass the dollar. They're creating payment systems that don't route through SWIFT. They're accumulating gold reserves at a pace that suggests they're preparing for a monetary reset. And here's what's fascinating. They're not hiding it. They're announcing these purchases. They're making it clear that they're moving away from the dollar. And yet, the mainstream financial media treats it like it's no big deal, like it's just some interesting geopolitical development that doesn't have implications for your retirement account, for your savings, for your purchasing power. But it does have implications, massive implications. Because when the world's reserve currency starts to lose its status, when countries start conducting trade in other currencies or in gold-backed instruments, the demand for dollars decreases. And when demand for dollars decreases, all those dollars that have been circulating around the world, all that currency that's been held in foreign reserves, it comes home. It floods back into the United States. And what does that cause? Inflation. Massive, uncontrollable inflation. The kind of inflation that destroys savings, that wipes out retirement accounts, that turns a lifetime of work into worthless paper. Now, I know some people are thinking, but the Federal Reserve can control inflation, they can raise interest rates, they can tighten monetary policy, and yes, technically they can. But here's the problem. The United States government is running trillion-dollar deficits. The debt is growing exponentially. The interest payments on that debt are already consuming a massive portion of the federal budget. If the Fed raises rates high enough to truly combat inflation, the interest expense on the national debt becomes unsustainable. The government can't afford to service its debt, and that creates a choice. Either you let inflation run hot, or you trigger a debt crisis. Either way, the purchasing power of the dollar gets destroyed. This is why gold is breaking records. This is why silver is surging. Because sophisticated investors, central banks, institutions that understand monetary history, they know how this story ends. They've seen it before. Weimar Germany, Zimbabwe, Venezuela, Argentina. Every time a government tries to print its way out of a debt crisis, every time a central bank tries to monetize government spending indefinitely, the currency collapses. The only question is timing, and the only protection is hard assets, physical gold, physical silver, things that have intrinsic value that can't be printed, that have served as money for thousands of years. Let me tell you about something that happened in the 1970s that most people have forgotten. After Nixon closed the gold window, after the United States defaulted on its promise to redeem dollars for gold, there was a period where people thought everything would be fine. The dollar was still the reserve currency. The system was still functioning. But then inflation started to creep up. Then it started to accelerate. And by the end of the decade, gold had gone from $35 an ounce to over $800 an ounce. People who had been holding paper assets, who had trusted in the system, they watched their purchasing power evaporate. But people who had moved into gold, who had understood what was coming, they preserved their wealth. They came out the other side intact. We're in a similar moment right now. The difference is, this time it's not just the United States making monetary policy mistakes. It's the entire developed world. Central banks everywhere printed trillions during the pandemic. Governments everywhere ran massive deficits. And now we're dealing with the consequences. Inflation that's proving far more persistent than anyone predicted. A banking system that's fragile and over-leveraged. Geopolitical tensions that are fracturing the global monetary order. And in the middle of all this, gold and silver are telling us something. They're telling us that the smart money is getting out of paper and into physical assets. Look at what's happening with silver specifically. Silver has always been gold's more volatile cousin. It's used in industry, in solar panels, in electronics, in electric vehicles. The demand for physical silver is exploding because of the green energy transition. But the supply is constrained. Most silver comes as a byproduct of other mining operations. You can't just turn on more silver production the way you can drill more oil wells. And when you combine industrial demand with investment demand, with the realization that silver is massively undervalued relative to gold, you get a setup for a price explosion that could make gold's gains look modest. The gold to silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has been historically around 15 to 1. Right now, even with silver's recent gains, we're still well above that historical average, which means either gold is going to come down, which seems unlikely given everything we've discussed, or silver is going to catch up. And when silver catches up, when that ratio reverts to its historical mean, we're talking about gains that could be absolutely life-changing for people who position themselves correctly. But here's what you need to understand. This isn't about speculation. This isn't about trying to time the market or make a quick profit. This is about wealth preservation. This is about protecting yourself from a monetary system that's in the process of failing, because that's what's happening. The banking system as we know it, the fiat currency system that's been in place since 1971, it's reaching the end of its lifespan. And when it goes, when confidence finally breaks, the transition is going to be chaotic and painful for people who aren't prepared. Think about what happened in Cyprus. One day, people woke up and the banks were closed. Their deposits were frozen. And when the banks finally reopened, a portion of their money was just gone, confiscated to bail out the banking system. Or think about what happened in Greece. People who had their life savings in Greek banks watched as capital controls were imposed, as they were limited in how much they could withdraw, as their wealth was trapped in a failing system. These aren't ancient history. These are things that happened in developed countries in the 21st century. And they can happen anywhere when a banking system becomes insolvent. Now, I want to take a moment here because this is important. If you're sitting on $100,000 or more in retirement accounts, you need to understand that there are options available to you that most people don't know about. I've put together a comprehensive guide on how gold IRAs work. It's in the description. This covers how you can get physical gold into your retirement account without triggering tax penalties, how you can protect your retirement savings from the kind of monetary chaos we've been discussing. This isn't about fear-mongering. This is about having a plan. This is about understanding that the rules of the game are changing and you need to adapt. Check out that guide, because what I'm about to explain next is going to make it very clear why this matters for anyone who's trying to preserve wealth through retirement. Let's talk about the mechanics of what's happening in the gold market specifically. There's physical gold, and then there's paper gold. Physical gold is bars and coins, the actual metal. Paper gold is ETFs, futures contracts, allocated accounts, all the various financial instruments that claim to represent gold, but are really just promises. And here's the critical thing. The paper gold market is many times larger than the physical gold market. For every ounce of physical gold that exists, there are multiple claims on that gold in the paper market. It's fractional reserve banking applied to precious metals. This works fine as long as everyone's content to trade paper claims. But what happens when people start demanding physical delivery? What happens when the institutions that have been selling paper gold are suddenly faced with actual demand for the metal? We've already seen glimpses of this. We've seen premiums on physical gold and silver spike above the paper price. We've seen delivery delays. We've seen mints struggling to keep up with demand. And this is before any real crisis. This is just the early stages of people waking up to what's happening. Imagine what happens when this becomes mainstream. When regular people, not just sophisticated investors, start to understand that their dollars are losing value, that the banking system is fragile, that they need to own physical assets. The demand for physical gold and silver is going to overwhelm the available supply. And when that happens, the paper price and the physical price are going to diverge dramatically. You're going to see a situation where the futures market says gold is one price. But if you actually want to buy physical gold, you're paying a massive premium. And at that point, the paper market becomes irrelevant. The only thing that matters is physical metal. This is why central banks are buying physical gold, not gold ETFs. This is why sophisticated investors are taking delivery, not leaving their gold in allocated accounts, because they understand that in a real crisis, paper promises are worthless. The only thing that has value is the actual metal in your possession. And this isn't paranoia. This is just understanding how markets work under stress. When confidence breaks, when people panic, the distinction between owning a claim on gold and owning actual gold becomes the difference between preserving your wealth and losing everything. Let me tell you about something that happened in 2008 that most people don't remember. When Lehman Brothers collapsed, when the financial system was in freefall, there was a moment where the paper gold market completely seized up. Futures contracts were trading, but if you wanted to buy physical gold, you couldn't find it. Dealers were out of stock. Premiums were through the roof. And this was in a crisis that, as bad as it was, didn't actually threaten the dollar itself. Imagine what happens in a crisis where the currency itself is in question, where people aren't just worried about bank solvency, but about whether their dollars are going to be worth anything at all. That's the scenario we're heading toward. And the evidence is everywhere if you know where to look. The central bank gold buying, the BRICS currency initiatives, the persistent inflation despite aggressive rate hikes, the banking system fragility, the unsustainable government debt, the geopolitical fracturing. All of these things are pointing in the same direction. We're approaching a monetary reset, a fundamental restructuring of how the global financial system works. And in that reset, the people who own hard assets, who own physical gold and silver, are going to be the ones who preserve their wealth. Now, let's talk about what this means for you practically. Because it's one thing to understand the macro picture, and it's another thing to know what to do about it. The first thing you need to understand is that this isn't about putting all your money into gold and silver. This is about diversification. This is about having a portion of your wealth in assets that aren't dependent on the banking system, that aren't denominated in fiat currency, that can't be inflated away or confiscated. Financial advisors traditionally recommend 5 to 10% of your portfolio in precious metals. But given what we're seeing, given the risks in the system, a case can be made for a much higher allocation. The second thing you need to understand is the difference between owning physical metal and owning paper claims. If you're going to own gold and silver, you want to own the actual metal. You want it in your possession or in a secure storage facility that you control. You don't want to own an ETF where you're dependent on the fund manager and the custodian and the whole chain of intermediaries. You don't want to own futures contracts that can be cash settled. You want the real thing, because in a crisis, that's the only thing that's going to matter. The third thing is understanding the difference between gold and silver. Gold is wealth preservation. It's the ultimate store of value. It's what you own to protect your purchasing power over the long term. Silver is more volatile, more speculative, but also has more upside potential because of the industrial demand component and because it's more undervalued relative to gold. A balanced approach might be to have a core position in gold for stability and a smaller position in silver for growth potential. But the exact allocation depends on your individual situation, your risk tolerance, your time horizon. Here's something else that's important. The window for acquiring physical metal at reasonable prices is closing. Right now, you can still buy gold and silver relatively close to the spot price. Yes, there are premiums, but they're manageable. But as more people wake up to what's happening, as demand increases, those premiums are going to explode. We've seen this before in previous crises. The premium on physical silver can go from $2 or $3 over spot to $10 or $15 over spot almost overnight. And at that point, you're paying a massive markup just to get the metal. The time to acquire physical gold and silver is before the crisis, not during it. Let me give you a historical parallel that I think is instructive. In the 1930s, during the Great Depression, the US government confiscated gold from private citizens. They made it illegal to own gold except for jewelry and collectibles. And they did this because they needed to devalue the dollar. And they couldn't do that effectively if people could opt out by holding gold. Now, I'm not saying that's going to happen again. The circumstances are different. But what I am saying is that governments, when they're desperate, when they're facing a currency crisis, they do desperate things. And one of the ways to protect yourself is to own assets that are harder to confiscate, that are more private, that give you options. This is why some people prefer silver to gold. Silver is bulkier, harder to track, more commonly used in small transactions. It's the people's money in a way that gold isn't. And in a scenario where there are capital controls, where there are restrictions on gold ownership, silver might be more practical for everyday use. Again, this isn't about paranoia. This is about understanding history, understanding how governments behave under stress, and positioning yourself accordingly. Now, let's talk about the timeline, because everyone wants to know, when is this going to happen? When is the crisis going to hit? And the honest answer is, nobody knows exactly. These things can take longer to unfold than you think, and then they happen faster than anyone expects. The Soviet Union looked stable until suddenly it didn't. The housing bubble looked sustainable until it wasn't. The banking system looked solid until it collapsed. These transitions happen gradually, then suddenly. And by the time it's obvious to everyone, it's too late to protect yourself. What we can say is that the trends are accelerating. The central bank gold buying is accelerating. The de-dollarization efforts are accelerating. The banking system stress is increasing. The government debt is growing exponentially. All of the underlying factors that are going to drive this crisis are getting worse, not better. And at some point, there's going to be a trigger. Maybe it's a major bank failure. Maybe it's a sovereign debt crisis. Maybe it's a geopolitical event. But something is going to break the camel's back. And when it does, the transition is going to be rapid and chaotic. This is why you need to be positioned now, not next year, not when it's obvious to everyone, now. Because by the time the mainstream media is talking about the dollar crisis, by the time your financial advisor is recommending gold, it's going to be too late. The price will have already moved. The premiums will be astronomical. The availability will be limited. The people who are going to preserve their wealth through this transition are the people who understand what's coming and act before the crowd. Let me tell you about something that's happening right now that should concern everyone. The US government is running deficits that are unprecedented in peacetime. We're talking about borrowing trillions of dollars every year just to keep the government functioning. And who's buying all this debt? Increasingly, it's the Federal Reserve. The central bank is monetizing government spending. They're printing money to buy treasury bonds. And this is the definition of a debt spiral. The government borrows more, which requires the Fed to print more, which causes inflation, which requires more government spending, which requires more borrowing. It's a cycle that ends in currency collapse. It's not a question of if, it's a question of when. And here's the thing that makes this different from previous debt crises. In the past, when a country got into trouble, they could borrow from other countries. They could get bailed out by the IMF. They could devalue their currency relative to other currencies. But what happens when the reserve currency itself is in crisis? What happens when the dollar, which is the foundation of the entire global financial system, loses credibility? There's no bailout for that. There's no higher authority to step in. The only resolution is a reset, a fundamental restructuring of the monetary system. And that reset is going to involve gold. It always does. Throughout history, whenever paper currency systems have failed, and they always fail eventually, the world returns to gold. Gold is the ultimate money. It's been money for 5,000 years. It's survived every empire, every government, every currency. And it's going to survive this one too. The question is, are you going to be holding gold when the reset happens, or are you going to be holding paper that's rapidly losing value? I want to emphasize something here. This isn't about doom and gloom. This isn't about the end of the world. Civilizations survive monetary resets. Economies adapt. Life goes on, but wealth gets redistributed. The people who are holding the right assets come out ahead. The people who are holding the wrong assets get wiped out. And the difference between those two outcomes is understanding what's happening and positioning yourself accordingly. It's that simple. Think about the people who owned gold in the 1970s. They watched their wealth multiply while everyone else was struggling with inflation and stagnant wages. Think about the people who owned gold in 2008. They had a safe haven while the stock market was collapsing and real estate was crashing. Gold isn't about getting rich quick. It's about preserving wealth through periods of monetary chaos. And we're entering one of those periods right now. Here's something else to consider. The younger generation, millennials and Gen Z, they don't have the same faith in the traditional financial system that previous generations had. They've seen the 2008 crisis. They've seen the pandemic response. They've seen the inflation. They've seen the wealth inequality. And they're looking for alternatives. They're buying Bitcoin. They're buying gold and silver. They're diversifying away from traditional assets because they don't trust the system. And they're right not to trust it. The system is broken. And the people who recognize that early are going to be the ones who preserve and grow their wealth. Now, as we're coming to the end here, I want to make sure you understand the urgency of this situation. We're not talking about something that might happen in 10 or 20 years. We're talking about something that's unfolding right now. The central banks are buying gold right now. The BRICS nations are building alternative systems right now. The banking system is under stress right now. The government debt is spiraling right now. All of the pieces are in place for a major monetary crisis, and the window to protect yourself is closing. If you've watched this far, if you've understood what I've been explaining, then you're ahead of 99% of people. You have information that most people don't have. You understand the risks that most people are ignoring. And now you have a choice. You can act on this information, or you can hope that somehow everything works out. But hope is not a strategy. Hope is not going to protect your retirement savings when the dollar loses half its value. Hope is not going to preserve your wealth when the banking system seizes up.